we'll look forward to continuing the discussion now. And in order to do so, allow me to introduce you to the intrepid Benjie Cherniak, moderator for the startup session. Benjie.
Thank you very much. My name is Benjie Cherniak. I am the principal of Avenue H Capital, which is really just myself advising and investing in startups, which is apropos because our topic today is pretty much everything to do with startups in our space and how they should approach the ecosystem, raising capital, et cetera, et cetera. And to that end, we have a very productive and accomplished panel, a combination of entrepreneurs, investors, C-level executives, startups themselves, and everything else in between. I'll do a quick introduction myself of each of the panelists. Then we'll jump into some topics, and we'll try and leave some time for those of you in the audience who may be investors or startups yourselves or other to ask questions as you see fit. I'll start all the way at the end with David Carruthers. David is a pioneer in our space, in the industry for approaching 50 years, give or take?
47.
47 to be exact. A good chunk of that spent with Ladbrokes, if I'm not mistaken.
In the beginning, yes, 24.
The first 24 years at Ladbrokes, and then went on to start his own sports book called Bet on Sports, which went on to become listed on the AIM exchange, raised $100 million. And now David is advising and consulting to startups globally, including in the Asian marketplace. We also have Ryan Lawrence, who is the founder of Betmate, which is an emerging sports gaming and company and technology company. They're redefining the space with a P2P platform geared to social gaming with an emphasis on responsible gaming, and look forward to hearing more from Ryan and his journey as an entrepreneur to date. We then have Martina Åkerlund, who is the CEO of Triggy, which is a gaming technology company within our space as well. Previously, Martina spent 20 years in C-level positions within the sports and technology sectors, technology primarily. Interestingly, Martina was the initial investor into Triggy and then took over as the CEO of Triggy, so kind of a unique perspective, both from the capital markets side as well as on the entrepreneurial side as it pertains to our topic at hand. And last but certainly not least, to my immediate left, we have David Flynn. Many of you may know him from his 20-year career as a C-level executive in our space, most recently as CEO, if I'm not mistaken, of the Glitnor Group, to which he's currently a board advisor. In his current role, he's entrepreneurial, both investing in companies as well as acting as an advisor on various boards, and also has a distinct accomplishment of having swam, what was it?
From Gozo to Malta, yeah, okay.
From Gozo to Malta. So if any of you are in the mood for a swim following the conference, follow David. He'll get you sorted and started out. So without further ado, we'll kind of jump into it a little bit. And David, I might start with you all the way over at third base, David Carruthers. These are obviously challenging economic times. What are some of the differentiators that founders should be thinking of when going out to raise capital in today's market?
Well, my first observation is the first thing they've got to do is know themselves. They've got to be able to articulate who they are, why they're there, and what they're trying to achieve. And that's before they even talk to me about their business model or their idea or their USP. But all of these basic things are really integral to presenting something that is attractive to the potential investor. It's not about, for a startup, it's not about how big you're going to be in 5 years. It's not about what you did in the last 3 months. It's about what's your vision, what's your difference, what makes you special, and most importantly, why you want this person to invest in you and what that person can bring to you and your business to help you go from level 1 to 2, 3, 4, and 5.
So building on that, I'll come to you as well, David. You have startups. What is the best way for some of the emerging entrepreneurs to prepare themselves for this, in the sense that they've got to go out and raise capital, but they have limited capital to begin with, whether they've raised or not, and they've got to go out and what's the best way for them to, with limited capital, to go out and build brands and acquire users and prepare to move the needle enough as much as they can to go out and raise more significant capital?
I mean, I'd say the first thing is just to make sure that they get the right kind of advice. Events like this are great, of course, for that, in order to network and find the right people to give you that advice. and working with, well, people like yourself, actually, in order to ensure that they can go out with the right message. There's nothing worse than having a deck and sitting there for 15 minutes with somebody when the message is all over the place and they don't really know how to do a proper pitch. Because then you can be, as an investor, wasting a heck of a lot of time, and they just don't get the message across and they won't get the funding. That's one of the hardest things for them.
Martina, being on the other side as someone who's out as an entrepreneur and raising capital, what are your thoughts as it pertains to that in preparing to raise capital?
You have to be well prepared and really think your business model through, your innovation, your passion. What do you add? Have a solid go-to-market plan, and just as you were saying, David, it's you have to be prepared for all types of questions. Just as there are all types of startups, there are all types of investors as well. So it's generally also a learning curve. If this is something that you're doing maybe for the first time, you learn as you're speaking to different kind of investors.
Ryan, I'd love to double down on that and get your perspective as someone also an entrepreneur in our space, accomplished, but also out there seeking capital. How do you ensure that the vision that you have in terms of the message that you want to send, and as an entrepreneur, how do you ensure that you align that in conversations when you're raising capital?
I think one of the first things that we do when we talk to prospective investors is really set out our vision for the brand straight away. So for us, we try to be a little bit more unique in the way that we place ourselves and position ourselves in the market. So we discuss more our brand values, responsibility, and straight away, hopefully, there's an alignment there between an investment vision and also what we're trying to seek out as a startup.
And I know for you, responsible gaming becomes part of your message. How do you kind of align that within your conversations with investors?
Yeah, so we kind of articulate our thoughts and feelings about some of the irresponsible practices that can be renowned in the space, and also how we see a future vision. And obviously you can reference numerous acts that are getting reformed, but also discuss our brand values and why we think the way that we do, our own personal experiences, and also what we're trying to achieve and disrupt, because the way that we look at it, it's easier for us to articulate ourselves what we're not. So we often say to people, we're not a sports book, not slots, not roulette, and no casino. We focus on responsibility, fun, people versus people, social gameplay.
Yeah, got that. Martina, you come from outside of our sector, right? And what do you view as some of the unique challenges that are specific to our sector, or how does this journey differ within our sector versus other sectors? Are there differentiators that you can speak to?
Well, absolutely. As we are in a sector that many private equity are actually having a policy that they're not investing in. Of course, it differs from many other industries that don't have that problem. They can approach everyone. But I think it's also amazing that we have funds that are really focused on our industry. It's extremely important to be able to raise capital to drive innovation, and that is essential to develop our industry in the best possible way.
Do you see mainstream investors as shying away from our sector? Is there a viewpoint in terms of, obviously there's some funds and investors who are dedicated to our sector, and you've had some conversations there, but when you look at some more mainstream investment, do you see them as receptive to our sector, shying away from it, a combination thereof?
Yeah, a combination. Many have policies, if you're looking to private equities, they are not investing in our sector. So of course, that makes it more difficult.
Where are your views there, David, as it pertains?
Yeah, I would agree with that. I think if I was to create a startup today, number one, it would be go for the network effect and make sure that you bring people into the business who are angel investors that really understand the business. For a number of reasons, I'd begin there. Really, number one is because the presentation material, you don't need to go into that much detail with it. Everybody actually understands what it is you're actually going to be talking about anyway. Number two, they're sat there for a reason. They're used to investing in companies that are in the gaming sector, so that way you've already beaten that barrier down before you even get in the door. And then number three, if you bring in people like that, then they also generally have a good network anyway that can really help you to find the, I'd say, key investor that you'll probably need then to back your Series A. And that's something that you really, really need within a group, is a really, really strong key investor who will actually then take the lead. Because that means that most of the other secondary investors don't really need to do as much DD. And a lot of secondary investors really don't have the time or actually want to go through that process. They will actually generally follow on from a lead investor in that respective, if it's a respectable investor for a Series A.
Right. So let me dumb that down a little bit, just in case. I don't want to assume that everyone here knows what a seed versus a pre-seed versus a Series A is. So the quick terminology on that is, if you're starting out with a new company and you're raising capital for the first time, that would typically be called either a pre-seed or a seed round, where you're raising a smaller sum from a smaller network. Oftentimes it's a bit of friends and family. What David's alluding to is, to the extent that you can bring in some form of strategics who know the space, in our case, iGaming, online gaming, sportsbook, casino, et cetera, depending on what your startup is. And then from there, you move to raising capital from more institutional investors, which might be venture capital firms. And again, that could be, depending on terminology, a seed or even to a Series A. And then from a Series A to a Series B, again, institutional venture capital firms, or potentially even private equity. And then away you go down your path of either IPO or getting bought out. In a perfect world. But let's back that up, David, and come back to you. So David Flynn was alluding to the importance in the early stages of bringing on people who are strategic, and you're one of those strategics. So as somebody who would be assisting and advising startup companies, what are the things that you think you would bring to the table that would help them in that journey, and how specifically would you try and help them?
Well, I'll start with something that's pretty intangible, but I agree with everything David says. And I would add one thing to it, and it's risk appetite. These investors know the industry. Their appetite for risk is already established, and they understand the dynamics of the industry. So they might not be, bulking it, investing in a business that's going to target the Brazilian market and expect that to become regulated and capitalize on that evolution and opportunity. From a practical sense, I don't have many peers in terms of experiential learning in this industry. But
not everyone else has 47 years of operational experience?
No, and operational and different environments as well. But the real thing here is about giving them and building their confidence in their ability to actually deliver what they've decided they want to deliver. Now, that might be encouraging them to bring on a non-executive director at a very early stage, where they can have a mentor and a soulmate, someone to go and cry to when things are not going right, and give them the confidence to go back and do it again. It can be pretty blunt in saying, that's overambitious. Look at this example and this example and this example, and look what happened to them. So it's pragmatic. It's not textbook business school stuff. You don't need to teach them about the Boston Matrix, but you need to teach them based on your own experience and how you overcome the challenges of migrating from print advertising to online advertising, how you capitalized on online advertising, how you dealt with regulation when you felt the regulation was strangling your business. So you pivoted and embraced regulation and created a new differentiator. It's stuff like that, practical things that business experience shared can build confidence in people that perhaps don't have that same experience.
So Ryan, for you, outside of the check that an investor would bring and the much needed capital to enable growth, what are the soft skills and to David's point, what are the things that you would be looking for that would assist in the development of a company moving forward from an entrepreneurial standpoint?
Yes, something that David mentioned earlier, the network effect, and that can be used
Which David?
David Flynn. And for us, it's the network effect of themselves within the startup ecosystem. So our lead VC is a company called Hatch Ventures, and where they'll be able to assist us is helping us talking to other mainstream VCs and also assisting us with what benchmarks we need to hit in order to hit that Series A target that we have in mind. So that's really important. There are other things that they can assist with in terms of, so when we started off, we were looking for a paid marketing consultant, and they managed to assist us in sourcing that person who has experience within the gaming industry. So those little nuggets of information, they can really help, and that allowed us to have more confidence in those campaigns that we began to launch.
And how important is it for you to raise capital from within the industry versus investors at large that might have other skill sets from outside the industry?
I think for us, it's important to have both. I think if you've got someone that has experience within this space, it's really powerful, really beneficial. I think help accelerate yourselves within the regulatory constraints of gaming. And then also for us, having a mainstream VC or having angel investors from other maybe B2C backgrounds is also important, just for the way that we look at things and sharing learnings from other industries that we can compare to ourselves, and also how we can onboard that information and apply it to us, so that we do see ourselves a bit more unique than other companies do. So I think it's really important to have both if you can. Obviously, it's easier said than done.
I'd love to get your views, Martina, as well, in terms of on a couple of things. A, how important you feel it is to have the right mix of strategics on your cap table and why, and how you would ideally want to see that structured. And B, to David C's point a little bit earlier, that those within the industry already have a risk appetite. Do you view that as accurate or not, and why?
Okay, to start with the first question. We have some great investors from this industry. We have YOLO Group, Sportsbet.io, they were our first customer. That was like amazing when you're a startup. And just as you mentioned previously, it's like a quality sign as well to other investors that has helped us a lot. We also, from our second round, we have Ikigai by the Sigma network. And of course, that also is a quality assurance, but helps us in a really great way with both like the Sigma network that all are like potential clients to us, but also the shows and the marketing that they can help us with. So that's an amazing combination for us. But I also think it's good when you mix investors from different industries. You get different points of view, and I think many industries are like facing the same kind of things now. It's data, it's regulations, it's user experience, and so forth. And maybe if you as a company are moving towards other industries going forward, it could be really great to have other knowledge as well. So I think the combination is good. It's always nice with different perspectives. And sorry, then I lost the other question.
My other question was, I was interested in David's point earlier that investors from within the industry have, I don't want to misquote you, have a better understanding of risk versus those from outside the industry as it pertains to our space, and have more of a tolerance for a risk investment. I don't know that I view all of that as 100% consistent with my experiences or for me as an investor, and I would love to get your views on it.
Well, like from an investment perspective, this industry have been like amazing. But of course, like if you have a knowledge of the industry, you lower risk just by having that. So of course, this whole industry is about taking risk. That's what we do and make money out of it. So I would say like the investors here, yes, they have a risk appetite, but I also like have to say that they are really qualified. So like to get good investors on board, there's so many investment opportunities for them. So it will never be easy if you don't have a good product and a good plan going forward.
That's a great point, and I'll maybe even come to you on this one. And just by the way, I know that you'd mentioned one of the investors, the YOLO Group, who are fantastic, and the Sigma guys, who are also fantastic. This being an iGaming Next conference, of course, we can no longer talk about the Sigma guys going forward as much as we love them. And I would take the opportunity to also mention that the iGaming Next guys was publicly released the other day that they raised some additional capital from some fantastic investors as well to be able to continue growing these amazing conferences and the brand that they provide for all of our benefit. But coming to you, David, I would love to kind of get your views on on a couple of topics. Let's start with the topic at hand, which is, you're now a board advisor. As an accomplished C-level executive, you know what's required to grow and build a company. And now as an investor in not just our space, but med tech and other industries, but keeping it more to the specifics of the gaming industry, where do you feel you need to add value, and then where do you feel you need to help companies in terms of their growth opportunities moving forward?
I think first and foremost, having spent the majority of 20 years in the B2B space, the network that I have probably is one of the things that people tend to look for most. That really helps with raising initial funds for any particular startup company, whether it's seed or pre-seed. And then going further on than that, it's about how to structure a company, how to build the company up. I'd say my strength is probably people and culture, and also commercial side of things. So it's about how does the business model make sense? Looking forward in your forecasting, does that make sense? Even now, looking at some of the decks that come across the table, even as late as last week, people are still using valuations from 2021 in order to estimate what the company's valued at, which you'd agree is crazy, right? The market's totally changed. Just some of the basics really around things like that. The last few years, I've been spending obviously running Glitnor, and then since I've moved into the board of that company, then it allows me to look at other interesting areas as well. Generally, I don't look at anything that conflicts with what I did operationally. But now I'm open to look at many different opportunities across the board and apply what I've been doing for the last few years.
You all heard that, right? Bring your decks to him right after this. But I'll stay with you, and then I'll come to David on the same question, is regarding valuations. And it isn't 2020 anymore when the valuations were sky high, and now it's a bit more challenging to raise capital. How should entrepreneurs view? Everyone views themselves and their company in as great a light as possible. It's part of what makes a great entrepreneur. But how do you balance that desire and that confidence and that inner, whatever you have, what you want to call it, of knowing that you'll be successful as an entrepreneur with the need to have a practical valuation so as to surround yourselves with the right people on your cap table? For you, as someone who's been on both sides of the fence, how should that dynamic be balanced for the entrepreneur? And it's probably not an easy answer.
Yeah. There are so many different companies out there at the moment that are looking for capital. So the first thing I'd say is, and it's an easy thing to say, it's a hard thing to do, is don't be greedy as a founder of a company. Simply because it's going to be very, very hard to be able to raise the right kind of capital that you need. At the end of the day, if you bring down the valuation of your company and you really do increase the amount of capital that you get in, and even if you're oversubscribed, take the cash, because you never know what might happen tomorrow in the marketplace. So take the cash and make sure that you use it to the best possible way that you can if you're oversubscribed. Next question.
No, that's good. So take the cash, take the extra dilution, and take the extra capital because it's a tough market.
Yeah, I've seen a number of companies that they go out in the marketplace and they try and keep such a high valuation, and either A, they don't manage to raise the capital, or they raise the initial capital, and then they have to do an immediate down round maybe 6 to 12 months later. Then your shareholders are not happy. Then you're answering all of those questions rather than focusing on growing the business. So, just be conscious of what your valuation is, because going back is really, really hard. Taking in additional capital in order to grow at a faster pace is a lot easier, for sure.
Okay. Interesting advice. Strong advice and interesting advice as well. David, over to you on a similar topic as it pertains to valuations, raising capital, and as someone who back in the early 2000s raised $100 million for your business, and now working with a number of entrepreneurs in different jurisdictions. How do you think about the valuation dynamic when there's a bit of a push-pull between you as an investor and an entrepreneur?
Sometimes I just cry because there's such a difference, between
Crying
the
works,
investor
man.
and the
Whatever
entrepreneur.
works.
In my role in this situation, I'm like an intermediary. I have to teach people realism on both sides. And I'm fortunate enough in that position. I also have to deal with huge cultural differences. Most of my team are from Asia, and they have different aspirations. They have different timescales, and they have different valuation metrics. So I need to be able to translate that to the entrepreneurs in the West and get them to understand it and believe it, and get them to believe in the synergies.
You do that in Mandarin or in English?
Sometimes I do it physically.
Got it.
You know, but no, I don't do it in Mandarin, no, because my Mandarin is good enough to go on holiday, but not good enough to do that. But I do understand what Chinese people are saying when they're talking to each other, which is very beneficial on my side. But back to the question, and it's like, how can the entrepreneur be more productive in this hostile environment? Be prepared to give a discount. Be prepared to show your belief in yourself that you can turn your now 20% into this much. So you don't really care that you used to have 80%. And if you get that message across, you will get a better valuation, you will get standing your ground, because you'll end up on the reverse side of what David is saying. You won't get enough new capital, and you'll be back again and again and again. And don't underestimate the disruption to your business that you have to go through to raise capital. It takes time, energy, and your attention away from the day-to-day running of the business. And that needs to be number one and always be number one.
And I hear you on that, you know, and if you look at the 2020 when things were at a boom, it was much easier to raise capital, and a lot of companies raised capital at what today is perceived to be too high a valuation, making it that much more difficult to go out and raise more capital without being forced to do a down round, which is a bad look all the way around and makes it all that much more challenging. But so I hear you on be prepared to accept the discount, and I hear you on take extra capital if you can get it. But at the same time, Ryan, like, you know, how do you balance that and at the same time try and defend your valuation?
Ask if we can rewind the clock 3 years. No, seriously.
That would be a great way to do it.
No, for us, I guess two main points on that one. Market research and growth planning. So for us, market research, understanding what valuations are in the space right now, what companies are currently raising at is really important. As David kind of mentioned before, not 2-3 years ago. To understand, make sure that the VC or the investors you're speaking to understand that your awareness of the market is right, is correct. Second of all, growth planning. So plan your future rounds out and make sure that the investor that you're speaking to really knows that you understand how to get from X to Y and to Z. Because then they're going to have more faith in you to deliver and execute on that vision, and will enable you to negotiate a better valuation in doing that.
Martina, how do you think about that? The balance between raising the right amount of capital, whether you're oversubscribing or not, and dilution. Like, how do you think of that formula when you go out and work with investors and raise capital?
Well, that's always a balance, of course. But I don't think I've ever heard of a company who said that they actually raised too much. So I think it's like rather have a bit of margin in what you're raising, so you have enough. And just as you said, don't be greedy on the valuation, but raise some extra because you probably most likely will need it.
Any views, this is a bit off topic, but we didn't really prepare for this, but any views on bootstrapping? And I guess to the extent that you haven't raised, like all startups are bootstrapping to a certain extent, even if they've raised some amount of capital. But is there a right or a wrong as it pertains, in your view, Martina, to a startup bootstrapping to protect equity before they go out and start raising?
Sorry, once again?
Is there a kind of a right or a wrong approach as it pertains to not taking capital and bootstrapping at initial stages before going out to raise capital so as not to get diluted right from the outset?
Well, that's like always like what possibilities do you have? If you really need if you need capital now to be able to grow your business, then you have to do it. If you are able to grow like with maybe your own capital or getting payments earlier or maybe by a loan or something, then it's amazing. But of course, if your only possibility is to raise capital, then there's no other option.
Ryan, any views on your end on the bootstrapping piece?
If you can do it, then it's nice to be able to do that. But also at the same time, the investment that you could raise would allow you to get from X to Y much quicker, and therefore accelerate your valuation perhaps further forward than if you weren't to do so. So it is a bit of a balancing act, and I think if you're B2B versus B2C, there probably is a bit of a debate over which route you go down from the outset.
May I?
Yeah, please.
So, there's been a number of decks all sent through. There's maybe 100 decks that could fly around at the moment for people looking for capital. Some of those decks don't have any substance whatsoever. So you have founders that have a great idea putting a deck together, maybe even have a great concept, but then they're not willing to put in any risk whatsoever in order to try and get a proof of concept off the ground, or even make some steps and invest their own time into it, whilst also maybe working at the same time. For me, if I come across something like that, it's like, well, okay, they don't even believe in themselves. But it's surprising how often that you see something like that in the market.
Yeah, and particularly if you got like a first-time founder who doesn't have like a track record and they don't have any proof of concept in terms of what they're presenting to you, and it's just a deck asking for a 15 million valuation. Like, what are you supposed to do with that?
Yeah, well, even less than that, but yes.
Yeah. How important is it for you, David, as it pertains to I guess somewhat talking about the topic of either bootstrapping or making a lot out of a little, how important is it for you to see some proof of concept when you're looking at an opportunity to align with a company?
Well, to give you the short answer, it's essential. To give you the longer answer, I'm looking for calluses, I'm looking for bruises, I'm looking for blood, I'm looking for reason to believe in these people. And the only way I can see that is in the story of the journey of where they came from, where they are now. And I think this something is also that can be done maybe when you go for second round or you go for the big exit. Go back to the people that said, thanks, but no thanks. Because this time you're right. This time you've got more information. This time you've got more convincing argument.
Got it. We spoke a bit earlier, and I'll actually come to David F. and then come back to some of you guys on this, but I'd love to get your perspective. By the way, Robert, we seem to have lost our clock here, so I don't know what our countdown situation is, or maybe the guys in the back can put it back up, but 10 minutes? 12 minutes. Okay, cool. So we were talking a little bit earlier about, or David alluded to a little bit earlier, about some of the differences within the Asian marketplace, and putting that piece of the world aside, but you're involved in the European, and you have some knowledge in terms of South American, I think, and North American. How do you view the differences from region to region as it pertains to both startup culture, investment culture, the types of opportunities and projects that get invested in, et cetera, et cetera?
Let's take product first. I think there's a lot more willingness to invest in the sports side across in the US, across in the pond, over the pond.
Today, anyways.
Yeah, today. And generally at a higher valuation than one would certainly see over in Europe. European valuations have been really hit hard. They've been low for quite a while, but all the more reason why everyone was looking to get into the US. But I think they're going to stay like that for a significant amount of time. In the US now, I'd say that people are generally looking at EBITDA valuations, but that's much later stage for many companies, of course. And revenue valuations have, at least halved than where they were back in 2021. Latin America tends to take a lead from the US in many ways, generally focused across, again, EBITDA valuations today, but there's a heck of a lot of growth in Latin America, and certainly a lot of opportunity in that market as well. So, yeah, bit of a mix.
And David, back to you, because you've been involved from an investment standpoint and advisory in a whole bunch of different continents and jurisdictions. How do you view those differences, and how does that pertain back to investors and entrepreneurs and how they should look at things?
Well, it actually comes back to the marketplace that the business is operating in, basically. Asia is under-regulated, shall we say. So therefore, the valuations of business from Asia are more modest than the valuations in a place like the USA, where the expectation for growth is almost exponential because, one day California will regulate, one day Florida will regulate. So there's still a growth story there that's huge. A different type of growth story than you see in Latin America, because that's an emerging growth story. That's built on population and emerging regulation. The American USA is built on economic power. And the other one is suppressed because nobody knows if it's going to be here today or tomorrow. And that's the main difference. So if I'm trying to raise money for an Asian business, I'm looking at a multiple of 2, 3, 4. If I'm trying to raise money for a USA-facing business, then I'm in double digits sometimes,
Martina, I know that when you were on your journey with Triggy, and I know that at one point there was more focus on US, both investment, operational, and then shifting back a little bit towards other markets. So how do you view the dynamic, having had practical experience in the last 12 months with different parts of the world?
Well, I would say US it's an amazing market, but it's also it's a difficult market, and also for a small company as Triggy, we're not a huge company. Getting established in the US, that takes a lot of time and effort from your company. So you really have to be prepared for that. It will take a lot of time for both having people in the US, but also from company if you're based in Europe. We see great potential in LATAM, and there we can work as a startup scale-up in a more cost-efficient way. So we're still active in the US with the connections that we have, but we see we can grow in a more capital-efficient way in LATAM and Asia.
Interesting. David, back to you, and I'm going to come to you in a second, Ryan, with the same question. But, obviously being involved in a lot of jurisdictions, how important to you and to investors in general is the regulatory piece, the responsible gaming piece, as you're evaluating opportunities?
It really depends on the investment objective. If the investment objective is to make money, then perhaps the regulatory thing is a barrier to making money. If it's a long-term sustainability, or if it's building synergies and consolidating things, then you're more embracing of regulation than otherwise you would be.
Ryan,
everybody's playing soccer here, but there's the Premier League and there's Division 2.
Don't we call it football? We're in Europe right now.
Oh, okay. No,
It's for your benefit.
Yeah, the time I spent in the USA corrupted me. Football. There's people in the Premier League and there's people in La Liga. They both play football, but it's different.
So, Ryan, what are your views on that?
I think for us, it was, because we are a UK-based company, it was paramount for us to have our license before we even started speaking to investors. We had very early conversations, and the obvious question was, well, you're not regulated, then come back to us when you are. So there was a lot of those conversations happening, so it was a huge barrier to entry for us to launch, but also to raise capital. And then on the responsibility angle, we've tried to make that a huge part of what we do at Betmate, and I think I do think that is the way the industry in the UK especially is heading, but especially if you are trying to attract maybe more mainstream investors, it's something they care a lot about because of the general reputation that the industry can have for them and negative impacts that could be correlated with that.
David, I want to get your views there if you want to add them, but I also want to add a different question kind of as a twist to this, is that, when you look at the regulatory piece, it differs from a B2C versus a B2B business. And it just kind of brings the question in totality of B2B versus B2C investments. B2C might have the higher TAM, but bigger risk in some instances, versus B2B, where you might see a more steady and reliable path. How do you view that dynamic as an investor? I guess I just said how I do, but how do you view that dynamic as an investor?
As an investor, I have fingers in all those pies. So, it's about balancing my risk as an investor. One On the B2C side, you have the potential of a very rapid growth, but the valuations tend to be lower for B2C businesses than B2B. B2B businesses take a lot longer to get off the ground. And I'd say you actually have less control of your growth profile on B2B, simply because the length of time it takes from signing contracts to actually getting live can be a bit of an unknown in some cases, depending on the relationship with operators. So yeah, as an investor, I try and balance both and make sure that I'm across the entire value chain, to be honest.
Cool. We're down to the last 3 minutes according to the clock, which is back in action. So I've got more that I can go with here, but if there's any questions from the audience, this would be a great time to bring those forward. Going once, going twice, done. All right. What are some of, for any of you who want to jump in here, what are some of the hottest areas coming forward as it pertains to attracting interest from investors? What are some of the hottest areas within our sector?
I think product generation and new product generation is one of the most interesting. Now, everybody talks about AI today as if it's the new, I don't know, just new or dangerous or exciting or whatever. But I do believe that that technology will transform the product in this industry, and perhaps transform it in a way the internet transformed it 20, 25 years ago. That's the most significant thing for me.
And how do you get your head around that as an investor in terms of it? Because everyone's saying AI, but how do you evaluate
the
that?
young man said earlier, research. You just got to dig deep, talk to everybody, read everything, and draw some conclusions. The harder you work, the more you know about what's going out there, the better decisions that you can make. You just have to try and do that efficiently.
Ryan, you're the young man in question he alludes to here. So what should investors be looking at moving forward as some of the hotter areas for opportunities for ROI?
I think if I put my Betmate cap on, I think we're looking at the social element of the B2C side of things, but then we also know there's a lot of value in the B2B area as well. And what we're looking at is hopefully establishing ourselves as a B2C brand, and then hopefully go down that B2B value chain as well. And hopefully that is something that can resonate with investors in that regard.
Martina, what are the hottest areas for investors, and what should be?
Well, I agree with both AI and social, super interesting, but I also have to come back to LATAM. We see many international operators that are going to that market right now. They have the processes, they have the tech, they have the structure, but maybe not the knowledge of the market yet. While we have local new operators that have all the knowledge of the market, but maybe they don't have the tech, the process, and the structures yet. So I'm looking forward to seeing companies that are able to combine the both.
David, 34 seconds or less. You got the last word.
All right. Sports betting, US product differentiation and innovation. Done.
You still have 27 seconds if you want to add to that. Yeah. I want to just thank our panel for all of their insights. It was really cool to have a mix of the investment side as well as some startups. So thanks all for your time.
Well done.